Today we're going to do taxes for Salvador Jimenez. And you should have the source documents in front of you there, the client write-up that we did, as well as Mr. Jimenez has two W-2s, a 1099 for some side business income, and then two mortgage interest statements. This should be kind of an interesting one, interesting practice tax return because um, it's the taxpayer's first time itemizing deduction, so first time using Schedule A, and with that type of client, a lot of times there's some consulting involved and some things that you need to kind of show them what they need to do. So first things first, though, let's go ahead and add the client to the database. Keep in mind always that when we're showing these videos, these are all just practice tax returns. So anything that you're seeing is not real client data. Just obviously out of privacy concerns. So Mr. Jimenez is a resident of California. He's a full year resident and federal and state electronic filing. Filing status: he's a single father with two kids. Okay, so as long as he pays more than half the total household expenses where his children live, he's going to be the head of household filing status. So that's going to be his most beneficial and a best fit for his filing status. Salvador Jimenez. Social Security number, you would confirm it off the W-2, but it looks like I was putting in all sixes on that one. He's a salesman. And what do we have for date of birth? Doesn't look like we have a date of birth for him, so we're just going to go 4/15/72. Okay, address. This is something that we might want to look out for, because if somebody just bought a house, like it's for his first time itemizing deductions, that might tell you that he just bought a house. He may have a different address than is on his W-2, so we would just want to, always confirm, get the correct address. Phone number, let's say he just has a mobile number. I'll put in our Van Nuys office phone number just to get that office little free publicity here on this here internet. Okay, preparer on this is going to be you, Pronto tax class graduate. So that's the taxpayer information. We're going to dependents. His two kids. One is Johnny Jimenez, and this would be a classic example of where, for the electronic filing system, the name has to match up exactly with what is on the Social Security card. So Social Security records, that's where the IRS gets their information. And so this, Mr. Jimenez may call his son Johnny, but is his name Johnny on the Social Security card? And you can prevent an electronic filing rejection and having to call the taxpayer and figure out what's wrong by just confirming, hey, is your son's name Johnny or John on his Social Security card? It's being detail-oriented at the start of the process will save you a lot of headache in the future, and more importantly than your headache is going to save the client headache and a hassle. So let's say that we confirm that it is Johnny on the Social Security card, and Johnny's date of birth is 2/19, and let's say it's 1996. Okay, date of social 617-52-3783. Okay, that's his son. You want to verify, hey, he lived with you the whole year. He generally would, but you just want to make sure of that. Make sure that this all fits together, and it looks like it does. Come over here, add another dependent. That would be the daughter, Teresa. Teresa, date of birth for her, let's say it's 10/15, extension deadline. And let's say she was born in 2001. Okay, her social is on your right up there. 19. This one Social Security number would normally mean that she was born on the East Coast. Those ones are East Coast socials. Little bit of trivia there for you. Daughter relationship, verify that she lived at home. She normally would. Okay, we're back to contents. Checking these two boxes for the electronic filing purposes. And then we would get straight into the income. So before worrying about any deductions, and the person's first time itemizing, they may have a bunch of questions about their deductions and what's deductible, what's not deductible. But okay, valid social. It's flagging this social here as not a good social. So I'm going to go ahead and change the social security number. And yeah, they'll take that one. So this is why they call it practice, because it's not real. So just trying to have a little fun here and do some practice returns, show you guys the process of what goes on. So we go in here to income. Whatever tax software program you're using, it's going to be much the same. You're entering the W-2 income. His main job looks to be from plush carpets. Okay, we would check here. Is it a retirement plan? There is a retirement plan, okay, on the W-2. You need to be able to pick that up. Check the box. Total wages, $68,089. So he sold quite a bit of carpets. $5,689. And then you can see on the W-2 that there are actually no state withholdings and no state information for California. We're going to go ahead and leave it like that, and we'll just do the federal return on this practice return. Normally, if this was a California taxpayer, you would have some state withholdings taken out. We want to look at this W-2 and see, make sure that there are couple other items on this W-2 that you want to pick up on. And number one item would be the Social Security wages are different than the wages in box 1 of the W-2. So that tips you off to the fact that there is a retirement plan, or it says D, code D in box 12A. So he diverted $10,000 of his salary into a tax-deferred 401k plan. That's why it doesn't show up here, but he does show up here. He needs to pay Social Security tax on it, but not income tax. And then the second one would be this code L. So substantiated employee business expense. A lot of salespeople may have this code on their W-2, and shows that they had some business expenses that were reimbursed by the employer. Okay, and then what I would want to check on here is not on Facebook. That's not what you want to do, but you won't find too much there that's helpful as far as taxes, as far as I know, although I definitely could be wrong on that. I would want to come up here and see with those substantiated business expenses, code L. So L on W-2. What I want to know is that amount included in wages, because that would affect whether he could deduct those expenses. Because if it's included in his wages, then he may be able to write it off again on his Schedule A, okay, on the miscellaneous or on the work expenses portion of Schedule A. So I'm not going to be afraid of the competition here. I'm going to see if this H&R Block article gives me some information about that. Let's see, it's going through W-2, okay. Box 4, so we want to match up the box that is in 12B, so that would be here, and we're looking for that L here. Okay, Okay, so amount of substantiated employee business expense reimbursement. So say the salesperson has an expense account with the employer, and they turn in, hey, I went on this sales calls for the month here. I spent this much on taking the clients out to, golf and trying to sell them carpets, and the employer pays them back. This L code on the W-2 shows how much the employer paid, but it's not taxable to the employee. So since it's not included in the wages, it just means that we can't deduct it on Schedule A because it's not included in the wages. So thanks to H&R Block for a nice little concise article and explanation on that, just to make triple sure. And this reminder also to always read the W-2s. It's not, if there's a code in those box 12 or box 8 or box 7, box 10, if there's numbers in those boxes, it's usually not a safe idea to just ignore them. You want to find them out, and wherever in your software program there's going to be some place to input that. You know, we can just for the fun of it, let's look at Drake software, and we can see. I bet we'll see a similar place. So on wages, here's the wages screen for Drake software, different software program. But here's the box 12. Okay, so if you wanted to go down here, L, we would put that in. And D, we would put that in. Okay, so a lot of the software programs are very, very similar, and a lot of it is based on data entry. You know, and hey, you have a W-2 in front of you, just make sure you're thorough and look at the boxes, and wherever the numbers should go in your tax program, make sure they're plugged in. A lot of times accurate data entry for a tax preparer is really half the battle. You know, if you can get the accurate data entry from the source documents, so W-2s, 1099s, into the tax software, you've done a lot of the job. So for this second W-2, we can come over here and we can see that, okay, he had a part-time job, looks like selling cars at Toyota, maybe like a weekend job or something like that to kind of boost up his income a little bit. So Toyota, again, we're going to ignore the state, the California stuff on this W-2, frankly, because I didn't fill it out when I was making the W-2s. And we'll just do the federal return on this. So income is $8,508. Withholdings, federal, $253. We can see on this W-2 there aren't any retirement plans or anything else too crazy about it. It's just a real straightforward W-2. So yeah, those would be the jobs. We got the wages in there. We would then want to identify, what other type of income does he have? Do you have interest income, dividends, pension income, gambling winnings? So we can see here that he has a 1099 from, let's see, looks like from Dish Network. So maybe he was also selling some Dish Network, another side job. And this one looks like an independent contractor work. So we would do a Schedule C, and it would be something like direct sales, let's say. So that would be non-store retailers. That would be an acceptable code. He probably doesn't have a business name. Cash taxpayer. This is Schedule C that we're working in now, so I'm going to put 1099. Okay, amount to 2,400. From this amount, we're going to take some expenses to maybe reduce that. So let's say he has some expenses associated with that type of work. It's probably not going to be a lot because it's really a side job. The main thing might be some mileage, driving to get to his sales calls and whatnot. So we can fill out the mileage portion. And we would go ahead and put the type of vehicle that he has. Let's say he has an 05 Dodge. Okay, he started this job on April 1st of 2012. Date placed in service. Total mileage and business mileage is probably not going to be a ton. It's only 2,400 of income. So you would get from the taxpayer how many miles. Act on the taxpayer's records, not your own discretion. Let's say it was like 2,100 miles. So on Schedule C, we'll go ahead and read that. Let's see. I don't want the Schedule C EZ. Suppress. Schedule C. So for Schedule C, here's that income, 2,400. Here's the car expense, $1,200, so about half of the income. Nice little write-off. It's going to reduce his income tax due on that. He probably doesn't have a lot of other expenses related to this. Like I said, this is probably a pretty much a side job. He already has 2 other jobs. So let's say he writes off a little bit of phone expense, and maybe he gets an iPad work portion. Okay, so he has an iPad for his sales calls. Not going to take the full amount, but maybe he'll take part of that expense as a write-off since he uses it for work. And maybe a little bit of meals and entertainment. Let's say it's like $127 that he spent entertaining and trying to get business from for his Dish Network sales. Okay, so pretty simple Schedule C. Again, we kind of want to, I like to, after I do some data entry, like to read what I'm doing. So this is Schedule C. You can see here the type of business, direct sales, okay, total gross income. You got some truck expenses, some other, smaller expenses. So you've basically deducted that down to $464 of profit from that activity. So depending on the taxpayer, it could be more, it could be less, but again, there's a reason why we call it practice. We're just practicing seeing the process that we go through to do returns. So that would be the Schedule C. Let's see what other, because we're still on income, so before we get to deductions, we want to make sure we have all the income in. So we have, what other type of income do we have? We got W-2s, 2 W-2s, we have a 1099 miscellaneous, and then we have a W-2G, which is gambling, from Neighbors Casino. So you can see here, gambling winnings and losses, Neighbors Casino, gross winnings, $2,000. They took out some tax, $200, paid it ahead of time. You got to put in the information for the payer as far as their address and such. Los Angeles 90024. Federal ID number for the payer. And actually, hold on 1 second, guys. Hello? Hey, can I call you right back? I'm actually making a little instructional video right now. Let me call you right back. Sorry, guys, had to pick that up. That was my wife, and she's 9 months pregnant, so you got to answer every phone call on that. So pardon the interruption. I just didn't want to make sure I wasn't missing anything too important. That brings us to our favorite point about tax preparation, is prioritizing. So telephone number, they actually require the telephone number now for these casinos. Okay, let's say it's 800. Okay, and then also you got to put in the date 1, which is box 4 on the W-2G. So we don't have that on this one, but we're going to go ahead and just say it was New Year's Day down at the casino, and it was a good day. Lacert allows you to directly from this screen, if you won 2,000, most with gambling, not to burst your bubble here, but most people that win money, they just automatically lose it back, and they almost always lose more than they win. You may already be familiar with that fact, but what you may not be as familiar with if you're a newer tax preparer is that you can deduct your gambling losses up to your winnings. So let's say he also had gambling losses of $2,000. Lacert tax software carries that through to the Schedule A, which is where that deduction would go. And you can see here it's going to show up on line 28. So other miscellaneous deductions. Here's that $2,000. Other tax software programs will handle it differently, but anytime you have gambling winnings, you have a potential to cancel out those winnings if the taxpayer has losses as well. If you just have losses, which again is probably pretty frequently in the world of gambling, that's why the casinos stay open 24 hours a day. If you just have losses, you can't take that to deduct against other income, but if you have winnings, you can use your losses to cancel out your winnings, so you don't have to pay tax on your winnings, as long as you have those losses up to the amount of your winnings. Okay, so that pretty much addresses the income side of it. At this point, we want to start looking for deductions to reduce the taxable income. So we have all the income in. We want to use deductions to reduce the taxable income. And this is, we're going to get into some of the questions for the taxpayer has about itemizing deductions. So when it's your first year itemizing deductions, most likely that's because you bought a home. So for this guy, you can see he has two Form 1098s. One is from, let's see, National Bank, looks like. Let me see. so National Bank 8,508, and you can see in box 2 of that one it has points paid on purchase as well. That's something to definitely keep track of, keep note of. And then he also has another 1098 from, let's see, that's from California Bank for about $2,500. So on the Schedule A, you want to basically explain to the taxpayer that now that you're itemizing deductions, what's happening is that instead of taking the standard deduction, it's going to benefit you to make a list of specific deductions item by item. So that's why it's called itemized deductions, because you're going item by item and adding up all your itemized deductions instead of just taking a standard amount that the IRS automatically gives you. So essentially what we're going to do here, Mr. Jimenez, is I'm going to read off some things that are deductible as itemized deductions, and then you would let me know if those would apply. If you don't have all the information that we need right now, we can just make a list as we go here. I'll pull up a Word document, and we can make a list of what else you need in order to complete your return. But don't sweat it, we'll be able to get most of it done right now. So any large medical deductions, and taxpayer might at that point say, well, I had some co-pays, but I do have insurance, and you can explain to them that, okay, see this adjusted gross income figure here? So for 2012, on your Schedule A, the medical deductions have to be over 7.5% of your adjusted gross income in order to be deductible. So you can just run a little number there, 28 times 0.075, right? And then okay, hey, if your medical expenses for the year between you and your 2 children are less than, let's say, $4,000, we know that it's not worth it for us to fill out that part of the Schedule A, because it's not going to end up being deductible because they have a limitation on it. So we'll go ahead and skip that. Now, ordinarily, when the person has withholdings, tax withholdings from the state, they're going to be able to use those as deductions here in the state income taxes, and that's going to automatically pull over in your software program and show up as a deduction on Schedule A. In this case, he didn't have any state withholding, so he's not going to have that. And we just move right down the list. We're just making a list of deductions. The next one that would apply would be real estate taxes. So we can use the 1098. A lot of times we'll have the real estate taxes on it, but in this case it doesn't have it. So when somebody buys a house, sometimes what happens is that you need to get the real estate taxes from the escrow statement. So let me show you what that might look like. So example of escrow closing statement. Okay, so in your mind that real estate taxes are deductible, and that he probably paid some somewhere, but they're not on Form 1098 like they are many times. So you may have to pull them off this is at the HUD-1 statement. So this would be a document that would be included in the taxpayers' home purchase paperwork, that big stack of papers that people get when they buy a house. And you could pull off here, see this? County taxes. So you need to find out how much did the taxpayer pay in those property taxes. And sometimes that's paid out of escrow. So it's like part of, you get a loan for $400,000 and they prepay some of your property taxes ahead of time, so you don't have to pay those out of pocket. But you still paid them, so it's still the deduction. So we would have to get that document from Mr. Jimenez, and that might be the first thing that would go on our list. In fact, I would want to have paperwork from home purchase. Okay, so you could just do something like this: items needed to complete your tax return. Okay, 1. And again, if you give the taxpayer some paperwork, something to take with them that's very clear and simple about, this is exactly what we need, sir, to finish off your tax return, you're going to be very effective that way, because you got to make it as easy as possible for your clients. That's the reason they're coming to you, is because a lot of the reason is because they want you to make it easier than if they try to do their taxes on their own. So using a list like this and giving, instead of just telling the person, because they could walk out the door and forget everything that you just said, especially in our environment where there's just so much information all the time. People have a very short attention span, generally speaking. So putting it down on paper and giving it to somebody, this is what we need, is going to be helpful. Just so we're able to complete this practice tax return, I'm going to go ahead and say he already brought that back to us, and he ended up paying $2,147 in property taxes, okay, out of escrow. So we picked up that extra deduction for him. Now, for an extra deduction, that's going to help reduce the taxable income. So in other words, it's not missing this deduction and remembering to check it is going to help you save your client money. That's the point of doing this, right? Same thing with the personal property taxes. The most common for this would be the DMV fees or car registration fees, and only a portion of that, not like the DMV fees themselves, but there's a personal property tax portion of those fees that is deductible. So let's say he has 2 cars, and the deductible portion of it, which they actually, here in California, they started putting that on the DMV paperwork. So you can take it right off that if they have that. The deductible portion, let's say from the 2 cars, is $351. So again, that's a deduction that's going to reduce your client's taxable income, is therefore going to reduce their income tax. Okay, now we're getting to usually what's the biggest deduction on people's Schedule A, especially for new homeowners, is going to be the home mortgage interest. And so you would get that from the bank paperwork, which is Form 1098. So somebody is, this is their first time itemizing deductions. They're going to say to you a lot of times, what do you need? What do I need to bring to do my taxes? Okay? And so this the Form 1098 from the bank is one of the things that they would bring to you, and that you would make a list for them. I want to give you a quick heads up here. I want to give you a nice little free gift, especially to all you newer tax preparers. Well, actually, first I want to plug our tax course, prontotaxclass.com. 50-chapter course, more than 600 questions with explanations. So questions that you miss, you're going to get feedback. We have tons of videos, instructional videos. Just a really solid product overall. So just want you to take a look at that. I also want to give you, aside from doing our own advertising here, well, everybody's got to do it. You're not out here working for free. We wouldn't expect you to do that either. I want to give you something from our website here, pronto4tax.com. It's our company website. A little text heavy. I want to kind of revise some of this, but hey, it is what it is. I want to give you one of our tax resources, especially for you newer tax preparers. This tax prep checklist that I made here. There's 2 versions. There's one with no itemized deductions, and then there's one with itemized deductions. So you can actually go onto our website, and you can download this for free just for you, as a special gift. And it'll enable you to basically I want you to respect our copyright, obviously, on this, and leave our stuff on this. Give us a little bit of credit, at least, for creating this. But this is something that you can use to give to your client and say, hey, they say to you, what do I need to bring to do my taxes? I got a 4-page document for you right now that's going to show you all of the different things that they should bring. You give this to your client ahead of time, they'll come more prepared to their tax appointment. So like I said, don't say I never gave you anything. That's a good little tool for you to use. There are some other good checklists out there as well, but that's one that you can use if you need one. I like to tab out the different lenders. I could just total up both Form 1098s here, but I prefer to for record keeping purposes to separate them. So California Bank is the 2,503. Okay, so that's your mortgage. That's deductible. You also have, though, on that National Bank, you have points on purchase. Points on purchase is points are basically prepaid interest to the lender. Okay, so you pay the bank points, and 1 point is 1% of your loan amount. And essentially, that's a way for the bank, for you to either get a better interest rate from the bank, or it's like an interest charge from the bank, so the bank can make a little bit more money on your loan. And these, when you have a purchase, it's fully deductible when you make the purchase, okay? So you get to write off that entire charge. And that's something that you could find right here from the closing paperwork on the home purchase. So if we went back to here, let's go back to that HUD 1. You can see usually it has it on there. Second page, yeah, it's going to be called either points, or it could be called an origination charge, loan origination charges. Those are the two most common names for that charge, and it is deductible. So when you dig into this paperwork and ask for the paperwork from the house closing, you're not doing that to just be annoying. Some taxpayers are like, I got to go dig that up, and I don't want to remember all the papers that I signed, and I couldn't even barely pay attention when I was signing them, let alone dig them up. But you want to portray to the client that the reason I need this is because I want to save you money. And that generally perks them up a little bit, gets them more interested to dig up that paperwork when you tell them, hey, this deduction may save you $500, so we need to make sure that we get it in there. That generally sweetens their mood as far as retrieving the paperwork. I would encourage you, though, to use this tool of making a list of things like that you need to close out the entire return. So first visit for the client, do everything you can there that you have, and then you provide a list. So amount of any non-cash donations, double check. Okay, you may have amount paid for laptop computer used at work. Okay, so whatever it is, whatever deductions you need, or if it's, say, double check that Johnny's name is Johnny on Social Security card and not John. Okay, when you give a taxpayer a list like this of things like, hey sir, check these off, and by the time you come back for your second visit, we'll be able to just bang it out and get it done, and that'll be good for you. It just helps the taxpayer to be organized, and helps you conserve your time. Okay, so time is money during tax season. That is something that you want to really absorb into your brain. Time is money, is something that you need to understand as a tax preparer. You want to maximize your earnings during that very busy time of tax season. You can talk to any experienced CPA, enrolled agent, experienced tax preparer. They'll tell you that that is 100% true. So I want to just make that point from the outset. Another thing that you get to deduct when you're using Schedule A, itemized deductions that you don't get to deduct when you're using standard deductions. So this person, Salvador Jimenez, this would be his first year able to claim, hey, I gave $100 a month to my church. Or maybe I have volunteer expenses. My kids are in Boy Scouts, and I sponsored a trip to Yosemite, and I ended up spending $540. I also drove 491 miles. Okay, so these are all deductions that you can take when you use Schedule A, the itemized deductions, but you can't take when you're using standard deduction. In other words, this is something new for the taxpayer. Okay, so it's all about educating and empowering your client, especially that first year where they really they know something's changed. Like, hey, all my friends told me when I get a house, I'm going to have a lot more deductions, going to be more difficult to do my taxes. Like, I'm probably going to pay more to do my taxes. I might need to, go to a more experienced preparer. I know something's going to change, but they really don't know what's going to change. And the first time you do somebody's taxes, their first time itemizing, that's your chance to kind of explain to them what is going to change. And that way they know next year and they're prepared. And like I keep repeating in some of these videos is, your best way to really retain clients and get more clients is to create a certain experience for that client. And one of the best parts of a great client experience for a tax preparer is that you're taking the stress away from this process for the person. You know, you're making it easier for them. You're making they understand what's going on better. Before, they never knew how taxes worked at all. Those are that's kind of experience that you want to create for your client if you want to have that client for the next 15, 20 years. If you're the type of preparer where you just want to kind of do short forms and just kind of try to get new clients every year, and but that's a hard slog. I mean, that's a really tough deal. The client retention is where the good money is in tax preparation. So I hope I don't sound greedy when I'm saying that, but I just always keep in mind for myself that being a tax professional is, yes, you get some enjoyment from doing these different tax forms and figuring things out, but I like to look at it as a business person as well, and I definitely encourage tax preparers to look at it as a business, because that's exactly what it is. So you have to think of ways that you can add value so that you can increase your earnings. And one of the ways to do that, one of the best ways to do that, is to create a certain experience for your clients, which doesn't include a lot of stress for your clients. Okay, I want to show you one other resource that we have at prontotaxclass.com that might help you, especially if you're a newer preparer. Okay, if you go to this Pronto Tax Class, we have one of the best pages on tax preparers' earnings online. We have a lot of good details on this page, if you're wondering. And then you can also get this free report here, which talks about 7 secrets of high-earning tax preparers. This is a report that I wrote just based on my experience working with other tax professionals and kind of learning what they do that's really effective, and some of my own experiences as well. So this is a free report that you can actually get directly from our website. And to get that report, you would just go to our website and click on this "How much money will I make?" You can get a really good detailed article and get the free report. So if you're interested in that kind of thing, that's another resource that I would offer you for free. Definitely check it out. And to complete the Schedule A, this last section here is the miscellaneous deductions. So this would be anything else work related. So you're asking the client questions when you're running down this list. Hey, are you in a union? Any union dues that would go here. Any unreimbursed employee expenses, anything that you have to buy for work that you don't get reimbursed for, that you need and that you use for work. So maybe that would be laptop, and then work portion only, because maybe part of it's personal. So maybe that was $517. What other type of thing for a salesperson? You might go here. And again, the taxpayer, the first time they're itemizing, a lot of times they don't know what's deductible. So you could go list of salesperson deductions. Okay, get a list. Oh, okay, tax deductions for salespeople. Nolo.com. It's a great resource, actually. So you could, right here. What about cars? What about meals and entertainment? Legal and professional, supplies, business gifts, client gifts. Do you have a website? Do you have a type of insurance? Okay. Maybe you want a tax deduction checklist from this Riley and Associates Professional Corporation. Okay, attorneys. Here's real estate, outside salespeople. Okay. See, here's a nice checklist from these guys. This is a great resource. Good job, Riley and Associates. Okay, a lot of stuff on this internet. The internet is really your best friend. The internet and your computer when you're doing taxes is your best hope to do the best job for your clients, which is definitely what you want to do. So let's say client gifts. Client gifts are actually restricted to only $25 per client per year. So they're operating on like 1970 prices, but let's say you gave out 6 gifts, $25 a piece, $150. Okay. You can also take off the tax preparation fee from last year. Let's say that the person, they didn't itemize deductions, standard deductions. They just paid us flat $100. Okay. And that's basically it. You just made a list. You just filled out Schedule A. You just itemized. You just itemized deductions. So congratulations. Let's go to Schedule A. See this, Schedule A. And we always want to, after we've done some data input, we want to read the forms and see, hey, what's going on here, right? So we go through, no medicals, it wasn't enough. You have some taxes you pay. It's mainly those real estate taxes. You also get sales tax. There's a sales tax deduction in here. Okay, the big one is the home mortgage interest right there. You have gifts to charity. That's a nice deduction there, $1,800. The work deductions, they have a limitation on that, so he wasn't able to actually end up with any of those deductions. That's okay though. We also have the gambling. So we can see here, just to familiarize ourselves, we go to tax summary. So see this deduction here, this $8,700. That would be his standard deduction for being head of household. But now that he's itemizing deductions, he's choosing to itemize. And we can look on page 2 of 1040 and see where it says itemize deductions or your standard deduction. So last year he was taking standard deduction. This year he has a bigger deduction because he's itemizing. So the bigger the deduction, the more beneficial, the more tax reduction that you get. So bigger deduction is better. Therefore, itemizing deductions is going to reduce his tax more. Okay, so that's the big picture thing. Did a pretty good job, I feel like, on the Schedule A. Showed you a couple things on that. He's getting some benefit from that. I want to look at a couple of the things that would not be, while we're on the topic of deductions. So an IRA deduction, we put in a little curveball in here that he actually contributes to an IRA. And just to show you that you got to be thorough when you're asking clients, especially with somebody that they may not know. They may not know everything about what's deductible and what's not. So we would have to ask him, hey, do you contribute to any IRA, to any retirement plan, individual retirement account? And let's say he did. Let's say he did the maximum for 2012, which is $5,000. That's going to show up as a deduction if he's eligible, which he is not eligible. Let's see, 68,000. Oh, you know why? Because he's an active participant in a work 401k already. See this? So when he's an active participant, you're actually disallowed because he already put in here $10,000 into this. So when you're an active participant and your income's above a certain amount, which you can show, it shows on this worksheet here. Okay, let's see. That's the threshold, 68,000. So he's over the threshold. He's at 79,061. See this? So that means he doesn't have an ability to contribute he doesn't have the ability to contribute and take a deduction for a traditional IRA. So let's see if he could take a Roth IRA. Okay, $5,000. Roth IRA, you don't get a deduction in the current year. Okay, but see, this taxpayer's allowed Roth IRA contribution is $5,000, so he could put into a Roth IRA. So he could contact his investment company and stop contributing to a traditional IRA because he's not getting a deduction for it, that's the whole point of, usually, of contributing to a traditional IRA is to get a tax deduction in the year of the contribution. Roth IRA is the opposite. You don't get a deduction when you put in the money, but you don't have to pay tax when you, within certain guidelines, if it's a qualified withdrawal, you don't have to pay tax when you take out the money, including on the earnings. So let's say he puts in $5,000 for this year, and that amount grows over the next 20 years before he retires. That amount grows to $20,000. He's going to have $20,000 of tax-free income to take out. So a Roth IRA is something that you might want to suggest for him to look into. Okay. Let's say he didn't do it this year. It's because he already put into a traditional IRA. So now he has what's called a non-deductible IRA contribution. And that is noted on Form 8606, non-deductible IRAs. Okay, so I don't want to get too deep into this because this is mainly aimed at beginning tax preparers, these videos, but this basically establishes basis. Hey, I didn't take a deduction for this $5,000. So by filing this Form 8606 with your tax return, you're establishing that when I come later to take out this $5,000, I shouldn't be taxed again on this money because I didn't get a deduction in the first place. I already paid income tax on this money. So that's why this Form 8606 is important. Again, though, don't want to get too crazy on that because this is mainly aimed at sort of beginner to intermediate tax preparers. You can always do additional research. It's something that with these videos, hey, if you have questions about other stuff, you just go right ahead and just research the heck out of it. Form 8606, let me read about this on the IRS website. What does this mean? Here's all the publications, and just, go crazy on it. Here's the form. Read the form. That's the kind of thing that separates really good tax preparers from people that are just okay. I mean, anybody can do a couple short forms, but if you're the kind of person that when you don't know the answer, you know how to find it, then you'll go to being a really great tax professional. And you have a lot more chance to earn more money. So that's good. Okay, one other curveball deduction I was going to throw in there is sometimes if you see the person has multiple 1098s from different banks, it's because they refinanced their home loan. Okay, so refinancing, you pay points or loan origination fee most times when you refinance as well. So again, that's a deduction that you need to pick up as a tax preparer. So you can see, hey, you have two Form 1098s here. Do you have two home loans, or what's the deal? Why would you have two? He says, oh, well, I right after I bought my house, my nephew is a loan officer, and he said that I could get a better rate because rates went down. So I went ahead and refinanced my home loan again. Then you would be back to the situation like this. Okay, well, let me get your closing statement, escrow, example. Okay, let me go back to that HUD 1 for your new loan, and let me look at your origination charge, okay, on your refinance. What did you pay to the bank in points? It could be called discount points or origination charges. That's a deduction, but it's a little bit different when you refinance. You don't get to deduct the entire amount in that first year. You have to take it over the life of the loan. So you would go, this is how Lacert handles it. Different software can handle it differently, but this is how Lacert handles it. I'm just going to show you the upshot from it. Schedule A points. K category is amortization. You would put in the date that the refinance took place. So let's say it was towards the end of the year. The date that the loan closed. The amount of the origination points, origination charges would be the basis. Okay, so let's say it's a $400,000 loan, so it's 4,000 in points. 1 point. 1 point is 1% of the loan amount. Straight line method, and then recovery period. If it's a 30-year loan, you have to take that deduction over 30 years. If it's a 15-year loan, over 15 years. Most loans are 30 years. Okay, so let's see how that plays out on the Schedule A. Now remember, points and loan origination fee, it's a form of interest. Okay, so you can see that here. Here's that $22 deduction. And then you can double check it. You can double check your math. Hey, here's a $22 deduction. Yeah, it's not a lot, but it's about being detail oriented and saving your client every penny that you can on taxes. So, you can double check yourself. 22. Or actually, you know what? That's only the very last part of the year. So to see the deduction they're going to get, because remember they closed the loan in November. Okay, so let's say that it's a $4,000 loan origination fee divided by 30 years. So it's a $133 deduction each year when it's the full year. This is only just for November and December of this year, right? Because he did it towards the end of the year. So hey, for Mr. Jimenez, let's look at his tax rate. Okay, what's his marginal tax rate? It's 15%. Okay, so that means that he's going to save whatever deductions he gets. It's going to be 15% savings, tax reduction. So if it's $133 deduction each year, 133 times 0.15. Okay, that's $20 deduction each year, basically. Okay, so 20 times 30 years, 600 bucks. Okay, so you just saved him $600 by getting that second, getting those refinance points in there as a deduction. So 600 bucks is not bad. It's more than you're going to charge him most likely to do his taxes. And that's the kind of thing that when you're very detail oriented and you have that mentality, you're sitting down with this client, you're thinking to yourself, how can I save this person money? That is really exactly what you should be thinking in your own mind. Clients appreciate that type of attitude, and it shows. It shows in your behavior. It shows in what you're willing to do. You're willing to go the extra mile for the client and find those deductions for them. People really, really enjoy working with tax preparers who take that approach. Okay, so those are some in and outs. Okay, another tricky thing here is non-cash donations. So for non-cash donations, that would be like donations to Salvation Army or anything that's not an actual cash or check. Is going to be, you can put that in here, non-cash donations. Hold on one second, guys. That was canceled on September 1st. It only went up till September 1st. Yeah, it only went up to September 1st. Talking about a discount code that we had for our tax update course, which I might as well just plug since I was just talking about it. renewctech.com. This is our tax update where you get all the new updates. And sometimes we do a coupon code for our loyal people that come back year after year. Unfortunately, that actually expired a couple days ago, so that person won't be able to get that particular discount. But it's still a crazy deal at $37. This tax update course. It's actually written. Course is written by my dad. I've been doing taxes for almost 50 years, so and pretty much taught all of us everything that we know. So yeah, that's just another shameless plug advertisement. So, like I said, sometimes I just got to do that. The non-cash contributions, that'd be an often missed deduction. Like people donate to Salvation Army, they may not think much of it, but once you start itemizing deductions, this is going to save you money. We already said he's at a 15% tax rate, so $350 deduction is going to be 350 times 0.15 equals $53. Okay, so tax reduction is tax reduction. If it's $50, hey, your client deserves to get that. Okay, let's see. So yeah, that's pretty much it. You just itemize the deductions. You want to explore here. Hey, you're a single dad. Let's look for some credits. You're a single dad. You have kids. One of your kids is younger. Let's see, 96, 2001. So Teresa, the daughter, is younger. Do you pay any child care expenses for her? And Johnny is born in 96. So 12, 4, he's like 16, so he's not yet in college. You don't have any college expenses. But what about if Mr. Jimenez went to college himself? You never know. He does have a few different jobs, so it'd be hard for him to find time to go to school as well. But you want to just probe around, see if you can activate any of these credits here that would reduce the income tax of the taxpayer. We've been going for a while on this tax return, so let's go ahead and move towards closing it up. Okay, let's see. To deploy this. Okay. So we're going to look at the diagnostics, see what's going on here. It doesn't look like anything too crazy. We already saw how the IRA's not deductible. Head of household, we want to plug that in. So we'll go to tax summary, see what's going on here. Okay, wages between the two W-2s. Business income, it was $2,400. We wrote off deductions to get it down to $464. Other income's the gambling. Total income $79,061. Part of the self-employment tax from this business activity is deductible. Deduction means you reduce or deduct, subtract from income. First year itemizing deductions, so he's got more deductions here. You got this is mainly property taxes, also sales taxes and car tags, car registration, personal property tax. Interest, that was the refinance points, the 2 loans, the points on purchase, all that stuff he went through. Contributions, he's got a nice deduction there. He's a pretty generous guy. Other miscellaneous deductions is gambling losses. Okay, so 21,160 is his total itemized deductions. That's going to be deducted or subtracted off his income before they apply the tax. And you can see again, that's a much more beneficial deduction than the standard deduction because it's a bigger deduction. That's why when you have a house and you're paying mortgage interest, it's generally going to reduce your income tax because you have a larger deduction than the standard deduction, generally speaking. Okay, so we're going to take the itemized deductions on that. That brings us to 57,868. We have one more deduction, which is the exemption, and you get one exemption for each dependent, including yourself. So Mr. Jimenez has Mr. Jimenez 3,800, and then Johnny 3,800, Teresa 3,800, for a total of 11,400 exemption deduction. Again, deduction means subtracting. So subtract from that 57. Now you're at their taxable income. So that's how much of the income is exposed to tax on the federal income tax return. You can look on page 2 of Form 1040 just to see the real, the tax summary is kind of like a summary. Here's the taxable income right here, line 43. Here's the tax, 6,351. Once we have the tax, we get to reduce that tax directly by whatever credits the person qualifies for. So you can see why he has 2 kids under age 17. Why is he only getting, he should get $1,000 child tax credit, right, for each kid, but he's only getting $1,750 for both kids, not $2,000. So why is that? That's when it's helpful to have really good tax software. And you can use these little worksheets and see, hey, what's going on here? Why isn't this $2,000? I want my client to get the full benefit that he's able to. So I need to make sure this is right. And you can see that they have a phase out where when your income is over a certain amount, in this case you can see it's 75,000. 75,000 if single, qualifying widower, or head of household. They start to phase out the child tax credit. I know it's crazy. That's not, if you live in a high cost state, that's not a ton of money. Especially when you're supporting 2 kids, but hey, that's how the tax code is. If you wanted to double check it, you could go here and go to child tax credit phase out for head of household. Okay, you can go to about.com. Like I said, they have generally some good info. Let's see. Yep, so there it is. The phase out. That's if your income's over that amount, your credit starts to get reduced. Okay, so you don't get the full benefit of the credit. It's kind of a bummer, right? But hey, that's why they call it taxes. Okay, so that's going to take off and reduce the income tax. That's going to bring. He does have a little bit of self-employment tax. That's the Social Security and Medicare tax on the business income. So on that income from that Dish Network sales job. So his total then tax for the year, his total tax bill for 2012 is $4,658. The income tax that was withheld from his W-2s. Okay, so over here, back to his W-2s, you can see, hey, he already paid some taxes ahead of time. And that's what that is. That's the withholdings. That's enough to pay the real tax. Okay, and then he gets a refund back, $1,484. Okay. So this would be something that a lot of times, just to finish off this return, I know I've been going for a while and throwing a lot of information at you here. A lot of times the person, the new homeowner, they kind of want to know how much did they save by buying a house. How much did they decrease their income taxes by buying a house? Because they have a lot of new expenses with the house, maintenance and property taxes and all that. So what you can do is to figure that out is you take, okay, here's your refund, $1,484, and then you can go back into the program and basically the difference between if you were to have a house or not have a house is that if you didn't have a house, right, he'd be back on standard deduction. So I could just go here to the itemized deductions and I could say for standard deduction. So here, see this? For standard deduction, 3. And then he was getting $1,484 as a refund. Now he owes $1,556, this underpayment penalty. We don't need that. Let's see. I want to take that off just so I get a clean. Okay, so 1541, that's what he would have owed. So he would not have gotten a refund at all. So I'm going to come over here and say, this is the amount that you saved would be, say you were getting a 1484 refund. You would have owed 1541. So your total swing is $3,025. So that's how much you're saving by having a house. In income taxes on the federal tax return is $3,025. Okay? So that sometimes lets the person know, like, hey, my house payment is more than my rent was, but I'm trying to figure out kind of like what's my true cost of being a homeowner, and I know I'm saving some on taxes, but the client might want to know and might put you on the spot and say, how much am I really saving, and then you can run that comparison, and basically all that entails is taking the tax return with itemized deductions and then do it without itemized deductions, and whatever the difference is, whatever the spread is between those two numbers is what the person's saving by being a homeowner. And keep in mind, that's a very general statement as kind of a rule of thumb. It's not, I don't want people to, write me emails and such saying that, well, that didn't work for this particular situation. Yeah, I know that. That's a lot of stuff that in taxes, it all depends on the situation. But that's a good general rule of thumb of how you can tell somebody how much they're saving in taxes by having a house, okay? So at that point, you would want to ask Mr. Jimenez, hey, you're getting a $1,484 refund. Let's do some direct deposit for you. So that should get your refund directly to your bank account. Okay, and let's go for direct deposit. Get your bank name, get your routing number, and get that money to you as quickly as possible so that you can make that next mortgage payment. All right, guys. So yeah, that was a good one. Couple irregularities there in the W-2s, and sorry about that. Well, as we go, we'll get better on our side and just be more and more detail oriented on our side. But yeah, I feel like that was pretty instructive overall. I didn't mean to talk your ear off too much. I just want to make sure that you're really getting your money's worth and that you're seeing the process at work. And this way, when you sit down with the tax client, you have some confidence. You feel like you've seen different situations before. And that's really the whole point of doing all these practice tax returns, to show you, is to give you that confidence of, hey, I've seen this before. I know I can tackle this. I know kind of the questions to ask when I sit down with a real person to do their taxes. Because I can guarantee you when you start doing taxes, it's something that confidence makes all the difference. So when you're confident, you're going to have a lot more success. All right, guys, all the best, and take care. See you next time.